10-year note yields remain near 1-month highs as we continue to push towards that 180 level, but we're unable to get there and unable to push through. So it's acting as pretty good support for the market as buyers tend to come in very quietly. Not a whole lot of buying needing to be done here. At this point, we're kind of between big data dates, and we traded higher this morning off of the retail sales, and then things kind of cooled off as the day progressed with possibility of maybe some positive rhetoric coming out of the UK and the EU with Brexit. So I think ultimately at this point, the bond market continues to see modest dips in price, pushes up higher in yield, but they are met with buyers. And if we get through 180, I think you're going to probably see some of those buyers take a step back, maybe wait until we get to 185 or 190 yield, but the idea that they do want to buy, they just don't want to be overly aggressive in doing it. Some that were overly aggressive a few weeks ago are now wondering why they had to be. And at this point, the technical picture is pretty clear. Yes, we are trending yields higher, but it seems that with all the fundamentals that are still out there, the market still has a lot of reason to go higher in price and lower in yield at really the drop of a hat. So at this point, buyers will be the controllers of this market as they wait. Will they step in more aggressively? Well, has yet to be seen. Another indicator that I think there's a big move coming, volatility. It remains elevated, although at the 14-day moving average, but it's been there for quite a few sessions, and that's very unlike this Treasury market to see volatility not going up or down pretty dramatically, and seeing a sideways trade at the 14-day moving average suggests the market may be waiting for something. Are we going to get that big move that pushes yields higher back towards 2%, or are we going to get that other big move that pushes yields back towards 1.5%? I think right now the market is not really sure. There's a whole lot of uncertainty when you look at the economic data, what the Fed wants, and likewise what we have coming up at the end of the month. And I think that volatility remaining elevated suggests that buyers will be in control, because right now if there's higher risk being priced in, that typically means that yields will go lower. It doesn't mean they will. Certainly could have yields pop higher if everything works out the way that the powers that be wanted to, but ultimately a 2% 10-year note yield seems a far-fetched as opposed to a 1.5% 10-year note yield, which seems very well within the realm of possibilities. Last, let's look ahead in the short term. We know it's coming at the end of the month, but what do we have in the short term? Well, today's retail sales indicates that maybe there's more economic weakness out there. We get Philly Fed on Thursday. Likewise, we get a slew of Fed speakers highlighted later in the week by Fed Vice Chair Clarida. He'll be talking about the economy and monetary policy, and likewise will be sort of a feeder for what the Fed wants to get a sense of how the market will react when he speaks or when Powell speaks. It's usually to get a reaction out of the market, whether they talk about being more dovish or more hawkish, and get a sense of where the market is and maybe if it's imbalanced or not. Currently, the Fed fund futures are still pricing in about 80% plus of a Fed cut at the end of this month. So I think at this point right now, it's what happens after the October FOMC, what happens in December, and that's really going to be the key here. And will the Fed maybe start to feed out some lines to get a sense as to where the market is? And if that maybe comes on this week with Clarida, maybe it comes when we get some more data and the Fed can maybe make a better assessment. But at this point, the market seems very well entrenched on a 25 basis point cut at the end of the month. Unsure now. We used to have a pretty good certainty they were going to do it again in December. Unsure now. And as yields creep higher, the probabilities decline that the Fed's going to be more aggressive. But with the uncertainties in the short end that we've seen over the last several weeks, coupled with the fact that we've had some weak data weakness, maybe if we get things to go smoothly with China and U.S. trade, with Brexit and all that, the Fed won't feel obligated to cut. But at this point, as I've said before, the Fed raises rates when they want to, but they cut rates when they have to. And if they have to go in December, it's a have to kind of cut, not a want to. But at this point, Treasury yields continue to push up. A trade above 180 would be significant, but we aren't there yet.